Part 1, Introduction to Inflation and its Impact on the Economy. Welcome, everyone. Let's start by understanding what inflation is. In simple terms, inflation refers to the general increase in prices and a fall in the purchasing power of money. Inflation is a natural occurrence in any booming economy, but when it rises above a certain level, it can create serious economic problems. In the context of the U.S. economy, an annual inflation rate of around 2 to 3% is considered healthy. When the rate goes beyond this, it becomes a cause for worry. High inflation results in the erosion of purchasing power. The same amount of money buys less than before. It also impacts savings as the real rate of return from savings declines. Most importantly, high inflation creates uncertainty in the economy, causing businesses and individuals to alter their spending and investment decisions. This sets the stage for our discussion on U.S. inflation crises. Throughout these episodes, we will look into significant inflation crises that the U.S. has faced, their causes, effects, and the response from policymakers. Part 2, The Inflation Crisis of the 1970s. The 1970s was one of the most problematic periods on the U.S. economic timeline concerning inflation. It witnessed a condition economists describe as stagflation, a combination of stagnant economic growth, high unemployment, and high inflation, a rare and destructive phenomenon. The root cause of this crisis can be traced back to the government's decision in the late 1960s to fund the Vietnam War and extensive social programs, like the Great Society, through debt. As spending outstripped revenue, the government resorted to printing more money, which led to inflation. A major oil embargo by OPEC in 1973 doubled oil prices almost overnight, adding an external shock to an already strained economy. The rapid increase in oil prices, combined with an expansionary monetary policy, pushed inflation into double digits. Inflation reached nearly 10% in 1974 and then rose to above 12% in 1980, causing a severe drop in the standard of living, exacerbating the recession and unemployment. Part 3, Policy Response to the 1970s Inflation Crisis. The struggle against stagflation in the 70s tested the capabilities and understanding of policymakers. The U.S. Federal Reserve under the leadership of Paul Volcker decided to take dramatic action. Volcker recognized that to break the back of inflation, the economy had to go through a period of cooling off. In 1979, the federal funds rate, which is the key interest rate controlled by the Fed, was raised sharply. This aggressive tightening of monetary policy led to a significant slowdown in economic activity and a rise in unemployment. Although it intensified the recession's short-term pain, the strategy succeeded in pulling down inflation. By 1983, inflation had fallen back to under 4%, setting the stage for a period of strong and relatively stable economic growth. This era affirmed the critical role of credible monetary policy in controlling inflation, a lesson that would echo in the halls of the Federal Reserve for decades to come. Part 4, Recent Inflation Concerns, Post-Financial Crisis of 2008. Fast forward to the 21st century. After the Great Recession of 2007 to 2008, the Federal Reserve dropped interest rates to near zero and embarked on a policy of quantitative easing. This move aimed to stimulate economic growth by pumping liquidity into the financial system. A side effect of this policy was an increase in the total supply of money, which theoretically should have caused inflation to rise. However, this didn't happen, and the following years saw relatively low rates of inflation. One explanation is that many businesses and households were deleveraging, or paying down debt, which kept spending and demand for goods and services lower than usual, helping to offset the potential inflationary impact of the Fed's actions. Despite all this, economists continue to debate this era, sometimes called the Great Moderation, and the lessons it provides for dealing with future inflation crises in the U.S. Part 5, The Present State and Future Outlook. As we speak, inflation is on everyone's mind again. The U.S. economy is bouncing back from the impact of the COVID-19 pandemic, and some signs point to increasing inflation. Economists argue that the Federal Reserve's current approach, which involves maintaining low interest rates to support the recovery, could set the stage for a new bout of inflation, especially with the government's substantial pandemic-related spending. In response, the Federal Reserve officials have insisted that they have the tools to combat inflation if it starts to get out of hand, and that they believe any near-term increases in inflation will be transitory. Inflation management requires a high-wire balancing act from our policymakers. It's not just about keeping inflation low, but also about preventing deflation and managing expectations. We all play a part too, as our spending and saving decisions can impact our personal and collective economic futures. In conclusion, the history of U.S. inflation crises offers valuable lessons, for economists, policymakers, and the wider public, on the benefits of proactive and prudent economic management.